Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data.
All right. Good afternoon. This is another episode of the Weekly Notebook Review. It is approximately 4:30 on Wednesday, February 15th, Eastern Time. Hope everyone had a great Valentine's Day yesterday. I don't know if that's like a global thing or not, but certainly is celebrated here in the U.S., and I am still in shock on how expensive those Dove chocolates were that I got my children at CVS. However, it was a huge hit, Mitchell, and they were very pleased, and it was $650. Well, it was actually $670. Well spent in hindsight. However, I still don't think Dove chocolates are worth $6.70. But that is neither here nor there. But I guess a decent tie-in into inflation, right, Mitchell?
Hallmark holiday cards for $8.99.
Also true.
I'd say a perfect tie-in. My wife laughs. She says, "I know you hate these Hallmark holidays." I'm like, "You're right. I do. I can't stand them. They're stupid."
Yeah.
Shouldn't need a day in order to make sure that your wife and kids know how much you love them, and that I just not my thing.
That is a very good point. I will say that my wife did enjoy the very small bouquet of flowers that my son picked out for her, so that was definitely a perk. But yeah.
Don't get me wrong. She still got 2 dozen 2 dozen roses, and my kids got 6 each. So yeah, I still participate. I just don't like.
Exactly, right? You're too funny. Now, I will say that I loved your tweet earlier, and I may kind of go off with that. But you were sitting, I'll pin to the nest here in a minute, but you were sitting in the coffee shop listening to a broker talk with a client. And I just want to kind of pass it off to you, because this is really why we do this, right? This is why we put in the work. This is why I was up at 4:15 this morning, caught a 5:15 train, coming to Stanford. One, I love this game, and I love working and wearing the Hedgeye jersey and working here. But at the end of the day, we put in all this effort, put in all this time, and reviewing the economic data, reviewing the signals, and that kind of thing. Because exactly, we want to play against the folks that you saw at the coffee shop today.
Yeah. So under normal circumstances, my morning starts at 5, and I start to get some work done. Tonight I'll get some momentum stuff into my notebook, and then in the morning it starts, and then I'll get to the gym. I'll take my kids to school, listen to the macro show. With Keith being away, risk ranges are a little bit on the later side, so I wasn't able to get them in when they came out, because I'm listening to the macro show, getting my kids to school. So I pop into a coffee shop after I drop them off, and I normally will put my earbuds in and shut out the world. And today, for whatever reason, I did not. And I am sitting there, and I just hear this guy start talking about soft landing, and your portfolio is up slightly this year off of last year's lows and blah, blah, blah. And he starts talking about, tech and communication. And I turn back, and there's this older couple who literally their eyes are just glazed over. Like, he's so talking inside lingo to people who just, they had no idea. I got the thought that they had no idea what he was saying. He was just trying to talk and sound smart, I guess, in order to impress them, so they didn't ask questions that actually mattered. Like, what data are you using to think that we might see a soft landing? Why would you think that, with the cost of capital this high that, things are sustainable? What is the data? Like, and this guy just keeps rolling on and on and on. And I was inches away from just kind of stepping in and saying, like, I almost lost my shit, and I picked up my bag and I just walked away, because I wouldn't want somebody in a professional setting to do that to me. At the same time, I'd at least have a rational conversation with them. There was no, I would have lambasted him and just embarrassed him, and it wouldn't have done any good, because then the people would have thought that I was just embarrassing him purposely. But it was bad. This guy, he was crushed. He was justifying why he got crushed, and then he's justifying soft landing to these people and talking about the Fed and blah 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 blah. And it was such an uninformed conversation that my frustration came out in a tweet. So yeah, it was pretty bad.
No, it's good. I mean, again, it's why we do this, right? And why you jump on. It's one I thoroughly appreciate you jumping on these calls and sharing your insight. I think most of Hedgeye Nation does as well. And you've got and I know you got a meeting at 5. So rather than me diving into it, if you're up for it, maybe we can kind of go into some of the things that you're seeing on your page today. I think before I pass it over to you, I will say, and I think it's worth prefacing that it's been what's the right word here, Mitchell? It's been challenging to navigate both sides of the brain, right? And reviewing the data that's been flowing in, the yield curve inversion that's happening, across, again, just data across multiple points. And yet reviewing kind of what's also going on in the marketplace, right? From a signal, from just a price momentum standpoint, et cetera, et cetera. So, I think we've done a really good job of pivoting, and you can see that in the RTAs, right? In terms of like 3 longs, 3 shorts. I think running neutral to slightly long has been absolutely the right move, and one that Keith has been talking to for the last, certainly last couple of weeks. And we haven't expanded or really gotten aggressive on the short side either here, letting things breathe, even with the data that's coming in. So, I just kind of want to start with that and preface that I think I know it's me here talking to everybody on Spaces, and those that will join and come speak in a minute. I guess want you all to know that I get it, right? Like, I get it's very challenging to kind of review both sides and yet try to still act and execute accordingly. There are definitely some big pivot points that are occurring, in my humble opinion, and I'll get into what I think they are here in a minute. But they're sort of listed up on the top of the page. So, but Mitchell, why don't I kind of pass it off to you?
Well, I know it's notebook review, and as I ran outside from where I was inside, I grabbed my laptop but left my notebook. But I'm pretty ingrained in the notebook, so I
have a feeling
I can rattle some
I have a
things
feeling
off.
you have it. You'll still be able to do it.
Yeah. So similar what you've said, and we've pinged each other, behind the scenes over the past couple of days. I think we're on a similar page. I see some major inflection points in a lot of the macro stuff, right? The larger, broader macro stuff that the equities really aren't. Well, I think equities are talking to us as well, but everybody, the equities kind of talk to you last, right? So the past few weeks, we've been talking about higher lows in the dollar, right? And, outside of a couple days ago, there were multiple higher lows in the dollar where people left it for dead. And then, you had a few, had it back off a little bit day over day. And then this morning you had a very large higher low in the dollar, and the dollar moved today. On the flip side of that, you see the euro, you see the pound weakening, and also the yen correlation with the yen going neutral, right? So I think the currency trade is telling us something. You flip to rates. You don't need me to babble what Keith rattled off. I think they're right? I think that you're going to start to see the long end come in a little bit. You just have your risk ranges and trend pretty much in the middle of your risk range, right? So, if trend on the 10 year is 363, when the 10 year goes to the top of the range, what is it, 380? It goes to the top of the range at hold up, I got my stuff in front of me right here. 10 year is 385, right? So it goes to the top of the range, you're bullish. If it went to the bottom end of the range, you're bearish, right?
Yep.
So
Now, with that said, it did
did
put
you
in a higher low today, right, at 340. So, just be
yep, I
to your
agree.
point, you just got to be conscientious and cognizant as to what that signal is trying to tell you. And right now, it's higher lows and higher highs, and it's not only is the price above trend, but also the top of the risk range is above trend. But you are absolutely spot on in terms of the math is saying on an any day basis on AK, because it's in the immediate term range. It could go to the low end and therefore, right back down below trend. So you're spot on there.
Correct. And I'd agree with your assessment as well. There comes so I know Keith got out of I don't know if I would say it, but he did
It's
he
okay.
made some moves in Macro Pro.
He made fixed income moves, yeah.
Yeah, he made fixed income moves in Treasury, and off of that, I was reducing some risk in Treasuries as well. I am not out of all of the ones that he's out of, and I still own a little bit more duration than IEF. I think my IEF position is 80 bips or something like that. So I'm not out of IEF completely. I actually have a little bit of a bigger position in ZRAs. Still not the end of the world. Couple percent, if I'm not mistaken. If I have 5% in a treasury position across the curve, I'm not thinking it's the end of the world, given that I do think that with this inverted yield curve, the inversion gets deeper. The recession risk is going to peek its head up momentarily. I mean, Keith always talks time and space, and time is now on our side, if you will, right? So, the closer and closer we get to April, we're in February, right? So March, April, we're 8 weeks away, 8.5 weeks away. So, the closer we get, the more the markets will start to discount this risk. And you got quiet periods coming up in the not so distant future. You got retail, shitcos on the back end, typically going to report earnings. My guess is we'll see more Children's Place, earnings bombs or pre-releases than not. So I think with what we're seeing in the dollar, with Keith noting that even where bonds are, they're likely to make lower highs from the recent highs, right? I don't necessarily need to be out of them. I'm just small enough in them to make sure they're a reminder on the page to then get bigger when lower highs are in place, and start confirming. So I'm looking treasury and gold. Gold, I'm kind of new. Gold, I know Keith is big on gold right now, or he's buying hand over fist. I have a decent size in gold. I'm still lower than mid, so I'm lower than midpoint. I'm just being a little bit more patient because I am a little bit lower than midpoint, and I want to see that sucker put in a higher low before I start to get really big again. But I think that's your trade, right? So equities, I still think we're starting to see some of the really high beta stuff waver. So I'm curious to see how the next handful of days play out in equities. I'm a bit more neutral, and I think with VIX down here, with the time frame running out, I know ODTEs are there. I happen to think we're at an inflection point where we do start to see things sell off relatively hard again. I'm not positioned for a very hard sell off right now, but I think that's where I think the signals are leading us more so than not, with all the underlying signs out there, all underlining signals, if we're keeping to the proper vernacular.
Yeah,
Would you
exactly.
disagree?
No, I think you're spot on across the board. I mean, so the big callouts are pretty much exactly what one of the top three things today coming in, which is dollar rates and gold. If you go back to kind of U.S. equities, and I say dollar in terms of like FX in general, right? FX exposure generally, so foreign exchange. But if you go back to like just the SPYs, they were up on low volume down to the low end of the risk range on the VIX. So I mean that's that's basically a setup that one given the quad outlook and what have you that you would fade, and conversely you got gold down on lower volume with GBZ still printing sub 15. So that's a positive. And you got gold the dollar, or if you kind of look at it through a UUP standpoint in the ETF, you've got that up volume, and again so like those are good signs, right, in terms of like the things are working in the right direction, and that kind of thing. So 100%. And for those that were listening in, zeros is our zeros. So Zulu, Romeo, Oscar, Zulu. Those are what are those? I think those are like 30 year.
Yep,
Or,
30 year.
30
Yep.
year ETF, like fixed income exposure that one can use. So definitely higher beta.
Yep.
And by that, I mean higher volatility. So just keep that in mind as you're kind of navigating those as well. But certainly, Mitchell, it makes sense. Mitchell might be expressing his kind of view through the 30-year, the longer end of the curve, given the kind of outlook there in the recession, with recession risk rising, with that, how that may impact the long end of the curve. I think, as I just said, the change today, though, right, on rates is bullish trends in the 30-year and 10-year, as you noted, Mitchell.
Yep.
So that's a move, right? And you got to understand and know what your rules and process are around that move, right? Is it to your point? Is it doing what Mitchell just did, which is kind of lighten up and assess and review, or is it cut and get out, right, and that kind of thing. So it really just depends, in my humble opinion, as to again, you got to understand Mitchell's running money professionally as an advisor, and so there's perhaps different tactics and moves to make inside of that portfolio versus what one might do in a standalone portfolio with no real rules or kind of compliance needs in place. So again, it just I know Mitchell's got his process and his rules and that kind of thing, but I just want to highlight that for everyone, because I think it is really important. There was a question, I think either in Twitter or somewhere, that I saw about what is bullish. Like, what does bullish on the 10-year and 30-year and 2-year really mean? So the risk range that you get every day is via is expressed in the yields. So when you're bullish on the yields, that means the yields are going higher. So it'd be bearish for something like TLT in terms of the ETF. So that would be the kind of, so basically they are kind of inverse of each other. So that's why this pivot point here at the trend line that Mitchell mentioned is quite important. So it doesn't mean that we're necessarily out of the longer end of the curve, aka TLT, maybe and IEF, but for now we are, because that's what the signal is saying, because it's moved to bullish trend on the 10-year and 30-year, aka bullish on the yields, moving higher. So just wanted to clarify that.
Yeah, in certain scenarios, like, so I know Apple just went bullish, trend. I'm not buying
the
Apple,
last few
right?
days. Yeah.
So
Yeah.
right. So I'm not going to buy Apple based upon the quad outlook and based upon what we think could happen, and Apple could go back to bearish trend in a blink, right? So with this position, A, Hedgeye is out of it, right? So I flat out know that. B, I'm not going to hold on to it and ride it all the way down, right? If it starts to move and I have my areas where I will just say, all right, I'll cut bait and fish somewhere else. Keith cut at his trend and mine's on a pretty short leash. At the same time, it's very small, right? So I'm not at 10% on any position, nowhere close. So on my fixed income proxies, I will go up to 10% on a handful of them. So I could have 30, 40, 50% in those if it's the time in a true quad 4. And if I have 3.5 to 4% max total in spread across 3 of them, it's not the end of the world. And we'll see if it, if the top end of the range keeps going higher, and if this thing peters out and starts to come back down towards the low end of the range. So this is more of just a wait and watch, where Keith would go neutral for a couple days. I'm just going neutral for a few more days. That's it. So yeah, I would not go crazy. It's not an advocation to buy. It's just, I am just staying more neutral for a few more days, and we'll see what happens. So that's it.
Yeah. No, good summation there. And speaking of signal strength, though, ITA certainly keeps putting in great signal strength in regards to the aerospace and defense ETF.
It really does. I have a slug of that as well.
Yeah.
One of the few things that I think are showing good signal strength. There's a lot that I think is more teetering on, neutralish but at the same time, still bullish trend, Hedgeye, and I'm waiting to see some strength come back to some of these names in a counter, in a counter to what the market's doing today. VIX spike, market sell off, etc. We'll see.
Yeah, perfect.
So I'll mute myself if you got some other guys.
Yeah, so Brian came up, so we can always go to him next if
Ooh, municipals.
Hey.
Muni,
Nice,
baby.
Brian.
Everybody loves municipal bonds.
Now they do.
How's it? I know, exactly. How are you doing, Robert?
Yeah, we're doing well, man. Doing well. Thank you.
Is it me, or does it feel like we're dealing with dog years here?
Dog years. Dog years. It also kind of feels
I'm aging rapidly, Brian. I'm aging rapidly.
It also feels a little bit like Groundhog Day. I feel like every week for the last month has been the same conversation, but one day it's going to be slightly different. But I mean, today actually this week is different. Honestly, the dollar rates and like FX rates and gold moves. I mean, this is a big. It's why I highlighted this more. I don't just tweet nonsense out there, right? When I say the top 3 things are important, it's because I really do. I humbly believe that it's very important. Today is an important day. Now, so I do think today's conversation will likely be a little bit different, but the market definitely keeps doing its thing, though, Brian. That's for sure.
Well, I've got a few things, but one of the things that I've been just kind of reminding myself, really kind of when this whole thing started, right, is that every quad 4 is different. And I think that, a lot of us have conditioned ourselves to expect certain outcomes. XYZ should be working now. And, every quad 4 is different. And so you just have to, define your process and execute it and be patient, but be measured as well. So you doing these spaces on Wednesday is great because SIFMA, which is the weekly tax-exempt interest rate, resets every Wednesday afternoon. And I talked about the mother of all moves last week, and we had another one today. So SIFMA reset to a 3.98% today. So 2 weeks ago, we were at a 187. Last week, we reset at a 374. And today, we reset at a 3.98.
Brian, how does that kind of compare historically, Brian? I mean, is it similar to
we've been in QE for a long time, so
yeah.
When you go back to
708 time frame,
yeah, you'd have to go back pretty far.
Yeah.
I mean, you're looking sub 1% like last January.
Right.
So we're talking monster moves here.
Monster. Yeah. Okay.
So one of the things I in terms of investing in weekly rate tax exempt paper, JMST is a JP Morgan fund that I've invested in. I'm not currently in it, but I may go back in it. I did have somebody who is in the brokerage space that, or in the bond space that has been following my posts and sent me a message that there's a federated fund called FFTXX that they like for weekly floaters. I have not looked at the fund yet, but I'm going to take a look at it. But for those looking for kind of the taxable equivalent yield calc at 37%, a 398 tax exempt is the equivalent of a 6.32% taxable equivalent yield. The bond that I pulled out of the JMST holdings that I was able to go on Emma and find the remarketing rates, the spread was plus 20 to SIFMA. So I would be looking for that same bond probably to reset to take a 398, kind of round it to 4 and add 20 to it. I'm thinking 420, 415, somewhere in there. So, I mean, we're really getting to interest rate levels that are, I think, going to put pressure on the tender option bond trusts that are out there that provide leverage to funds. And so I've been, kind of saying it for a while now that we really need to be mindful if you're in bond funds, what's the leverage position, and don't be caught in something that potentially might find itself upside down. The taxable rate that we look at to kind of compare SIFMA to is called SOFR, and it moves with Fed funds, so it's still at a 455. We then take the percentage of SIFMA to SOFR, and we're now at 87.5% of SOFR, which usually are kind of in the target of like 66%, about 2/3 of the taxable rate. So we really have some kind of pushing and pulling going on with this with these short-term rates. And as we've talked about for a long time now, a lot of things are leveraged, and it just feels to me like we're at a reflection point. But at the same time, if you're looking for tax-exempt weekly rate paper, these are rates that we have not seen before. 398's the highest. Was higher. It's higher than anything that we saw in December as well, when I was talking about SIFMA as well. So the other thing is on MMD. So just general municipal market, deals coming to market today. I'll go ahead and get my 1X. The muni market today got fucking crushed. The 1-year rate, the 2024 maturity, went up 15 basis points, and it was already up double digits Tuesday it was up 5. So I mean, for a 1-year bond, a municipal bond, we're up 20 basis points in 2 days. Those are moves I have not seen before.
Hey Brian, sorry to cut you off. I know Mitchell's got to hop here, but I think he might have a quick question for you.
Sure.
Yeah,
I do. On some of those leveraged funds, do you understand the mechanics when rates go up as they're going up, and how the leverage affects their liquidity? Could you run through that or explain that a little bit? Or
yeah, sure. If you type in, if you go to the internet too, just type in tender option bond trust. The first thing that'll come up is like a Nuveen example. But I'll give a generic overview of it real quick. But there's a couple little things I'll leave out. But essentially, what they do is they take 4% and 5% coupon bonds and they stick them in a trust, and then they issue weekly floaters, and they take the spread and pass it back to the investors in the fund. And so that trust operates very efficiently and perfectly, right, in a normal interest rate curve market, because your weekly rate is going to be, say last year, right, 1%, and you got 4 or 5% coupon bonds, so you're keeping a spread of 300 to 400 basis points. If you have 4% coupon bonds right now in a TOB trust, and SIFMA just reset at a 398, you don't have any spread. And we saw all last year these funds were doing what's called tax harvesting, where during QE they bought a lot of 2% and 3% coupon bonds because that's all that was available. They were getting rid of them all last year, taking tax losses and then recycling in to 4% and 5% coupon bonds. And so now I'm going to be interested to see in the municipal bond market if we start seeing more fives and even some six handles. Because last year, when kind of bond vol in my world got turned upside down in Q3, Q4, we did see a few six handles, some six coupons. So you can always run leverage, Mitchell. It's just a question of having that higher coupon bond. And then the unwind process, right, to reconstitute your trust, that could have some losses associated with it. Does that make sense?
It does, and I'm just wondering if with this spike in rates, how much that could adversely affect the system, if you will. Like, I'm just trying to process it. That's all. I appreciate the answer. Thank you very much.
Sure. Yeah, I think what would happen when a trust, so quote unquote blows up, right, is you basically reconstitute it by buying higher coupon bonds and selling the lower coupon bonds out. But all of that does not come without a cost. Right.
And that's where fund holders can get whacked pretty good. I mean, it's not like they're holding, as you try to educate people on, if you're holding an individual bond itself, that bond might get smoked from a price perspective on a couple week basis or a 5-month basis. But at the end of the day, so long as that credit is good, you're going to get your money back and your coupon. In a bond fund, that's not the case, and you could be staring at some decent losses if this kind of unwinds in the wrong direction. Fair to say?
Fair to say. So you're talking duration risk, and so if you just buy the individual bond, whether it be taxable or tax exempt, you hold it to the maturity or it gets called out. You're going to get your principal back. What you're saying is a never-ending fund, you could get caught with a NAV that's underwater, or they're running leverage and taking risk that you end up underwriting.
And this just points to your earlier. I think you alluded to it. Just trying to say it a different way for some people who might not understand bond funds is the duration that you hold, or the duration that manager holds within the bond fund, is very important to understand. If you're in a shorter term bond fund, it's kind of counterintuitive for people to think, but if you're in a shorter term bond fund and rates are moving higher, you're much more apt to see that bond. Well, you're more apt to see that bond fund go down than even if we're in a longer term bond fund where the beta is greater. If yields do start to do what we anticipate based upon recession risk, yields will go down. Yields should, in theory, go down on the longer end, thus moving price higher, as opposed to duration that's shorter in some of these shorter funds. So usually people try to hide out in shorter funds, but that might not be the trade.
Yes, I would agree with that, but I don't think there's a lot of funds that are only long duration like that, that don't run leverage. There could be a few of them out there, but when I go through and pick through the holdings, there are things that I don't want to own. And so when you talk recession risk, the long end comes down, but you also have a credit quality spread. And that's why I talk about that fund MMIN that I like, which is an insured municipal bond fund, because the insurance companies will only insure essential service. So again, I don't own any bond funds right now. During QE, you kind of had to be in leveraged bond funds. Nothing was really defaulting. It seems like we got some headwinds in front of us. So, buyer beware if you're in a fund and it has leverage, and buyer beware if you're in a fund and you don't read what kind of credit quality that they have.
You and I are on the same page. I agree with everything you're saying there. Thank you very much.
If I can just add a tiny bit, this is John Camprath. Hey guys, the closed-end Unibond space is kind of a unique space. Probably not many people on our spaces listening here or talking here really participate there, but it's a huge area of income for a lot of retirees, because your Merrill Lynch's and UBS's of the world like to have their advisors sell these things. And what has happened is we're in that, that concept of, inflections or processes, they're not points. We're looking at, and I follow, just for the fun of it, about 25 closed-end muni bond funds, these things trade like stocks on the stock exchange. So you have the share price on the one hand, but then you also have the net asset value inside. And of course, the net assets are what's supporting the dividends. And the dividends are usually paid out quite a bit more, higher yields than just your regular municipal bond market because of the leverage that we were talking about earlier. Well, that leverage is getting squeezed. It's getting squeezed really ugly. So the process of this inflection is still falling out. So I'm looking at some BlackRock funds that over the last year have cut their dividends 40%. Oh, and by the way, the fund is down 23% from its 52-week high. It's actually down more, I think, on a cycle. I just don't have that. But the idea is, there are things going on with investors where we're looking at permanent capital loss. We have massive drawdowns in these fund prices, but we also have dividends being cut. Now, there are some funds that only cut their dividends, say, 15%. Well, again, this is a process. It's not a moment in time. And with SIFMA having reaccelerated these last 2 weeks, to Brian's point, we're going to have a lot more inflection here. And so there's just going to be tons and tons of carnage, and just something to be aware of. And why might it be interesting to us? Because at some point, this process is going to bottom, and fund prices may get so beaten up that even despite the cut dividends, there may be some real juicy deals to pick up at some point, either for capital appreciation and or attractive tax-free income. But again, this is all to be worked out, because if it's higher for longer and SIFMA stays up really high for a long time, this whole area of your kind of core affluent investor in a lot of RIAs, and especially the wirehouses and the major firms, they're really getting beaten up. Thanks for letting me chime in.
That's great. That's great color. It basically goes back to the higher cost of capital scenario, just doing more carnage beneath the scenes, under the sinkhole before the surface area collapses. And a lot of the surface area has collapsed in those 25 items that you follow.
Exactly. But on the flip side, picking up something that's essentially just these tender option bonds or a close equivalent to them. I mean, geez, you can just buy some relatively safe paper, very short dated, yielding around 5% tax free. And then of course you do the tax equivalent yield calculation on that. So there's already, probably some smart places to park money besides maybe just hiding out in taxable treasuries and T-bills and whatnot that also pay well. So again, thanks a lot, fellas. Really appreciate you taking my time to let me be on here.
It's great color. Thanks, guys. Thanks, Brian. Thanks, Robert.
Yep. Thanks. Yeah, and I agree with John. And John and I have been pinging back and forth a little bit, trying to find different opportunities on these weekly floaters. But number one, you have to have a need for the tax shelter, right? And number two, they're not investments that you put in an IRA, not even eligible for an IRA. And then lastly, I guess, Robert, I did a pretty lengthy tweet about a CD that was on Fidelity. Apparently it's sold out, but first time I'd seen it, 4.8%, a little more than a year, monthly pay, call protected. Hadn't seen a 480 before. Also saw some JP Morgan CDs that are not call protected at 5%. So the CD space, for those that are, want something very vanilla, safe, something you can understand, that space seems to be on the climb again in terms of rates. I've had some discussions back and forth with folks regarding treasuries versus CDs, because treasury income is state tax exempt, not federal, but state. And yes, in the 6 to 12 month space, you're going to get a better yield than, say, a CD. But a lot of people just don't understand treasuries. So I'm really more just trying to get people to think about fixed income and a stream of cash flows and kind of how to make it work for them. So just want to give a shout out to the folks that have been pinging me about treasury yields. I am aware that within a certain duration there is value to be had there as opposed to CDs. But with that, Robert, I think the big item for the week for me are two big items. Is number one, SIFMA reset higher. It didn't reset equal. It reset equal to 374. It went higher. And then number two is the municipal bond market today just got smoked. And so I'm going to start watching the secondary market. There's a bond that I own. I bought it at 4.25. It's being offered. There's some odd lot being offered right now at 4.20, 4.11, 4.20, somewhere there. Last year, I bought some of these same bonds at 4.90s. So I'm going to start bird dogging the secondary, and if I, find some stuff that I like, I'll tweet it out, and people know to go look and see if they can find the same type of paper that may work for them.
Yeah, appreciate it. And John, thanks for sharing that historical chart on SIFMA. That was awesome. I've pinned it up in the nest. I've actually put a few things up there, including a couple of those tweets that Brian just mentioned in regards to different U.S. kind of tax-free rates and the state tax brackets and that kind of stuff across the country, and how to play that from a federal and a state level.
Hey, Robert, can I add one more thing?
Yeah, of course. Buddy.
Just in full disclosure, I'm not really that good in Quad 4, so like I don't own really any stocks or anything. So, I think folks out there need to know or need to hear that not everyone is buying and selling all different kind of stuff during Quad 4. It is okay to say I'm not great at Quad 4. I will play fixed income. I'm getting a good return, and when we get Quad 1, 2, 3, you can get your feet back in the water.
Yeah, very, very well said. And I would agree with you. I actually had a conversation with a gentleman earlier this week, and he was kind of going through his list, and about 70% of the book was in cash equivalents, and I was like, yeah, that's a good thing. I mean, that's like kind of the way it should be in terms of you got no real compliance restrictions on you, and that's okay. I mean, the whole point of this process is to preserve and protect, and to come out the other side with with kind of a similar capital stack. And if you can do that, you're going to be well ahead of the curve and well ahead of many out there. And then you get even more kind of capital to try to compound and protect on the flip side, right? So spot on, Brian. And I know, John, you're doing this kind of certainly professionally as well. So, but thanks again, John, for sharing that SIFMA. So I included that. And that CD analysis you did, Brian, was really cool. I think that came through last night. I was kind of reviewing that in the hotel room, and it was really, really well done, man. I think CDs are certainly something that I'm familiar with, but hadn't really seen it broken down in the way that you did it. So I'd really encourage anybody. So if people aren't aware, and for those listening in after the fact, via podcast or what have you, if you come back on a Twitter, look at this was going to be pinned to my profile. And then pull up the kind of the nest. So if you kind of click into the if you're listening it now, the nest is sort of at the top. So you just kind of like pull it down slightly. You'll see a bunch of tweets from Brian and John and Keith and Christian Drake from Hedgeye as well, who's put together some phenomenal content around the economic data that's been flowing in this week as well. But yeah, Brian, I mean, it was really cool, man. That was really good breakdown, not only from one, I had no idea that Fidelity had 241 brokered CD new issues. That's like insane. And then secondly, just sort of the breakdown in terms of, and I think CDs obviously work completely differently than money market accounts. So another huge thing there to have in your back pocket when you're thinking about cash equivalents.
Yeah, and I think the point that I wanted to make with people is, if you do want to preserve your capital, but also play in the space a little bit, the monthly pay CD is kind of unique, and you could just take a portion or all of your monthly payments and just have them drip into, consumer staples or things that work well in Quad 4. And,
Yep.
On the other side of it, you're going to have your principal back, and whatever happens with the interest payments is what happens with the interest payments. So that was just giving ideas for people that may be, wanting to play, but a little bit timid with what's all going on.
No, and maybe it's just kind of happenstance. I've been pulling some of these CDs for my kids, who are like about to be 6 and 4, and there's like restrictions as well in terms of like age, but that's a whole other subject matter. But I've been kind of diving a little bit into them, and they're not all created equal, and what's offered is different, basically by bank, and yeah, it's just like it was just your breakdown made a whole lot of sense because I've been sifting through a lot of different kind of BS out there, and I was like, I don't understand. Like, this should be pretty fucking simple. So it's a CD, Brian, right? Like, how hard can this be?
It's just a cash flow stream. You just got to create it and figure out what to do with it.
Exactly.
So, well, I'm going to jump off
man,
and hit. I'll still
appreciate your
listen in,
insight.
but I'm going to hit the treadmill. But nice
No,
talking
appreciate
with
your
you.
insight, man. No, appreciate it very much. John, I mean, I don't often have you up here. So pleasure. Thanks for tuning in. I don't know if there's anything on your plate that you're kind of reviewing or seeing in terms of how you're positioning either for your client accounts or even just generally within.
Sure.
I know you're very in tune with the macro landscape, but yeah, if you're up for
Well,
sharing,
I'll share. I'll
love
share a
to do
couple
it.
things. Number one, if you're
Cool.
a Hitchhiker's Guide to the Galaxy fan, I think just the last few weeks, the closing zero, the OTDE chart kind of looks like the menu for the restaurant at the end of the universe. I mean, we've got this macro thing that is on the verge of collapsing at some point, right beneath the the volatility surface, and yet there's just this kind of insanity of rushing after you know opportunities and daily liquidity, and it seems that between that and a combination of the government still propping up people in various ways, there may be more money out there in this otherwise shrinking credit environment that's allowing this to perseverate and continue for some time. To that point, then as an investor for clients, I am going extremely conservative, kind of more like Brian's point. I mean, I'm hanging out in all sorts of highly liquid, interest-bearing things with guaranteed protection of principal, and just waiting for the signs to get a lot better that we're going down, and then I'll take some action and put some more money at risk to make money on the way down. But I just don't want to chase, so I'm just being extremely careful. And what's so difficult in this period of time is that what is the stability to income? So you got a lot of retail investors on, say, the closed-end fund space that we referenced earlier, but just what's the stability to dividends and dividend growers in this environment? Probably okay, but then you're still risking losing a lot of principal in the short term if you're buying and holding stuff for clients that that want income but also want to know that their money's there at the end of the year. So I'm just finding it to be an extremely difficult period to trade through. So I don't know that I have any insights that are going to really enlighten anybody, other than maybe if you're feeling that way. And I know we're not supposed to feel in Hedgeye, but if you're somewhat perplexed, I don't know that I have the guide to the perplexed, but I'm just being very cautious and careful, and I'd rather have more at the end of the day than, gee whiz, I didn't make money chasing discretionary and communications and all that the first part of the year. I don't know if that's helpful, but that's kind of where I'm at.
I think very helpful, and the analogy with the Hitchhiker's Guide to the Galaxy is a great one. So very, very nice. I was not expecting that, to be honest, but that was a great segue, great synopsis or great analogy. But no, I mean, yeah, you're spot on, John, across the board, right? And I think approaching it that way is a very prudent measure, and one that obviously comes with a lot of experience from yourself. So it's I appreciate you sharing those insights. I really do.
Hey, man, my pleasure. Good luck to everybody.
And so just a couple of things Richie just sent over. Again, there's a little real time components here. Again, never really done this before, but I do think it's sort of telling in terms of. So he classifies he has a huge ETF list, and it's called the noise bucket for those out there, and the top five. So I'll highlight the top five. And if you, John, are you still up here? Maybe what general exposure do you think the top five are inside the noise bucket?
Oh, is that one of our things to look at?
No, it's just something internally that he sends around. But I just want to highlight it because I think it is interesting here. So just general. So like, what do you think it's like? Discretion, growth, Bitcoin, whatever. I don't know. Like, yeah.
Well, people are probably reacting to what they're seeing, right? So, So I would think it would be, growth and discretionary stuff with communications maybe mixed in there.
Yeah.
I would say, certainly Bitcoin on a day like today. I mean, one of our colleagues here put a little tweet in. I think he's jumping in.
Nice.
So we'll see if I'll let
So,
him name
yeah.
himself if he wants to get in there. But I know there's
Yeah, exactly. Yeah.
some of that's going on.
So is that a fade? Right, exactly. No, just kidding. But yes, in the noise bucket, the top five are all Bitcoin related. So it's DApp, digital transformation,
Really.
WGMI, Bitcoin miners, GFOF, future of finance, Grace by Grayscale, the BITQ for Bitwise crypto innovation, and then BKCH, which is Global X blockchain. So that's all in the noise bucket, top five. So just in terms of like the noisy stuff, John, absolutely, you're spot on in terms of Bitcoin. And yeah, some of the other ones might be ones that you'd think like YOLO had a big day today in cannabis. Same with iBuy, online retail. So again, just but the other one that stood out to me, and it is a number three here on terms of best performing. Generally, the global ETFs would be the dynamic software. Or really, you could just say, like semis, but in this case, PSJ. That was one that I had on my list in terms of things I'm paying attention to, both semis as well as PSJ to be more specific. I think so. That's Papa Sierra Juliet, and on the again not shorting it. It's still got some price momentum, but certainly it would appear as though it's kind of on the cusp of being overbought and perhaps having a little bit of exhaustion here at a lower high, and it has a lot of downside risk in terms of if you kind of take that bigger view backwards on say a 5-year chart, and it's got about 40% downside risk to just the highs of late 2019 to early 2020, and those are ones that I really are trying to kind of go find and kind of see what that signal looks like from in terms of the ones that iBuy, for instance, is online retail, but it's already well below its kind of late 2019 levels. So again, not that saying can't go lower, because valuation can absolutely do that. The bottom always can go lower, is I guess my point. But finding ones where you can like semis, for instance, still has similarly has like a 45% downside to just the highs of late 2019. So if
gravity is always there, and I mean, just take your PSJ and you take a look at a chart that kind of goes parabolic the last few days. I mean, it's indicative
Exactly.
of what's probably happening. I mean, overbought is maybe an understatement once that happens. But again, I think there's just a lot of free floating, very short dated liquidity out there that people are making quick bets here. And you could really get run over if you're not careful, really, on either side of the bet, because it seems like it sure should go down, but gosh, it may not be. So
yeah, and no, exactly. And Chris is jumping on. Chris Moore and Arthur, thanks for
I'll
jumping
back
up as well.
off, guys. Thank you.
Yeah, no, appreciate it, John. Yeah. So with Chris, I know it's getting a little late there in the UK, so maybe we'll go to you and have our resident FX expert kind of walk us through what you're seeing out there.
I was just coming along to make a joke.
Oh, and here I am, asking you to give us your wisdom. All right, I'll let you do the joke first.
The Mercedes F1 reveal for this season was today, and it was really weird. There's no FTX stickers on it. I don't know why. It's really weird. It's not plastered.
So weird.
It's not plastered in massive FTX stickers. It'll be really weird. I think the only one so far, the only one that's still got them on there is the Red Bull.
All right.
Bybit has
Who's the sponsor?
Bybit has disappeared. Tezos has got really, 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 really small. And there's a few on the McLaren. The McLaren have still got a few on there. They kind of got big on the McLaren NFTs and stuff. So, yeah, it was just weird that there's no FTX stickers on the Mercedes car this year.
That's amazing. That's amazing. I love that.
But
love that.
Yeah, not really massive insight. Just in terms of like FX is just watching this, like the underlying components of the dollar. Everyone always focuses on the DXY, which is obviously massively skewed to the euro. But I build baskets that are trade weighted, so it's more linked to the actual trade that's going on, which is with a lag because the BIS, when they release their data, it's like 2 years. It's 2 years old, but yeah, it's just looking at the underlying components that are starting to shift, like the pound, the yen. Starting to kind of put some upward pressure on the dollar again. So yeah, it'll be interesting with these, whatever's going to come of the rate hikes that everyone thought were over, I guess.
Yeah, so where in along those lines, I mean, the Japanese yen turned neutral inside the risk range today. How are you looking at kind of that exposure and the overall impact, or some of the things that kind of maybe not correlation is the right word, but kind of may play off of sort of the potential shift here in terms of a signal strength moving back to USD JPY bullish versus where it's come from, which was bearish to now neutral.
Yeah, I guess it's all about the shift in how the respective central banks are going to the speed or the perceived speed of rate hikes between the different two. So it's now been what we were pricing in was the fact that the Fed was kind of done with, that kind of beat inflation, and hikes were going to be whatever all these people are talking about, like the curve was this and that, whatever, into the middle of the year, and then it was going to price in cuts. Well, that's kind of shifted now, right? So whereas before it was Japan was starting to see inflation and was actually having to do stuff and was fucking around with their yield curve, well, now it's back on the US. So yeah, it's just going to be this big, how the other central banks are going to have to react to the fact that the Fed might have to keep hiking.
Yep.
So yeah, so that's, and as you can tell, like I don't listen to all that bullshit. I just look at what the price is doing. So, and just most recently, coming out of the back end of September, the dollar lost momentum massively, and it's just starting to pick up again. So yeah, I can't remember whether I commented when it was in a chat, but I think Keith's protecting himself, right? In terms of like bonds and everything, it's got run over by it last year. So whatever the signal for him has changed, if it does go back to how it was last year, the dollar was the only thing that was going up. So if the perceived reaction is that the Fed's going to have to hike again, everyone that now thinks that we're in whatever quad 2 or quad 1, or it could be round 2 of getting run over. I'm not saying that's what's coming, but if everyone has to start pricing in these hikes again, then everything will go correlations to 1, and it'll potentially be another washout again. So just be careful. Maybe think about where you're going to put cash, and I actually mean cash. I know guys are on here talking about CDs and stuff, but I would just be careful because I know it's crypto, but lots of people said they were going to hide out in crypto, clipping like 20% coupons and stuff, and that didn't end well. So maybe hiding out and clipping 5% coupons potentially might not also end up that well either. Maybe just actually having money in the bank and actually having cash. So
that good old currency, whatever it might be. Yeah. You know what worked well last year was PFIX. That worked well last year.
It did work well, yeah.
Yeah. Hasn't no one's really talked about that bad boy, but it's poking its head up. It put in. It's on the cusp of putting in a 1 month high. It tried to today. It didn't quite close up there, but keep for those that may have forgotten about PFIX, I'd be putting that bad boy back on your list. If you kind of take a step back, it would have put in a kind of higher low on a longer term 1 year standpoint here. But again, just PFIX certainly worked. But that was between that and the dollar. To your point, Chris, was about the only two, or one of very few. Hey guys, can you hear me?
I can now.
All right, cool.
Now we can.
Sorry about that. My wife was FaceTiming me. I think she forgot I had my weekly notebook review happening. So when you get a phone call, it kind of kicks you out of Spaces. So sorry about that, guys. But yeah, we were talking PFIX and dollar. But no, good insight, Chris. So thanks for sharing that. And I did have I made a mistake. I'm sorry. When I was speaking about PSJ, I was actually thinking about PSI. So that PSJ is dynamic software. It was up like a little over 4% today, but it's actually in line approximately with its high from 2019. Early 2020. So I just wanted to correct that. I misspoke. It was PSI, which I was looking at, which is semiconductors, which looks exactly like SMH, just two different providers. Those two have about 40% downside. So just wanted to kind of clarify there in case anybody, just wanted to correct my mistake. So PSJ, dynamic software, different than PSI, which is semiconductors. Semiconductors, that would be, although currently bullish trend, I would be looking at, maybe not bullish trend. They are bullish trade, certainly have price momentum, but they are top of my chopping block. All right, well, we're kind of an hour in. Arthur, I love your commentary. HYG kind of worked today and is starting to break down. So that trade's working for you. But you probably have other commentary as well. I mean, last time you surprised me with your little Bitcoin conversation, your little Bitcoin question. So loved it. You're a man of many. You're like an enigma, you like the calm HYG, but then also the high beta from the Bitcoin.
Yeah, well, after Chris spoke, I thought that was real good. I mean, kind of thinking like he is on this dollar thing, but I mean,
the dollar
Bitcoin
looks.
jumped.
I'm gonna say the dollar. It looks awesome.
Yeah.
Like it is a big higher low this morning and higher high. I mean, that signal strength is freaking awesome. And Leslie, huge shout out for keeping everybody calm 2 weeks ago when it was right above tail duration, basically closed like 5 pennies above it, or it might have been 6, but it doesn't really matter. But 5 pennies above that tail duration, reminding everybody about that. And 2 weeks later, that signal looks completely different and is at absolutely the top of the list.
So I didn't see the correlation table today with gold and the dollar. What's it at right now? I didn't
So
see,
on a
Robert.
15-day basis this morning, it was negative 0.93. It's pretty much that way across the board going back to 120. I mean, it's 0.93, 0.92 on a 30-day, negative 0.96 on a 90, and negative 0.95 on a 120-day. So massive inverse correlation.
Yeah. Well, I mean, that was so, today, the signal went out, so I got a little but some of that interesting in face of the dollar thing. And
so the dollars, I mean, sorry, the gold's really
they were saying the correlation might break out.
Yeah, and I mean, gold's really trading off of real rates. Right? So real rates going higher is not good for gold, but real rates again, I've got them, I think in my calculations right, I've got real rates at around 1.41. And they peaked kind of in October timeframe at around 1.72, and put in a lower high in late December around 1.62. So again, keep an eye on those real rates. You can, if you grab my watch list, which I've shared on the Arena, and I can share again for any subscribers, on TradingView, I've created kind of a global macro watch list, and it's one of the tickers in there under fixed income. So that's something that to be kind of paying attention to, in my own opinion. But yeah, I mean, Coach alluded to it or mentioned it specifically in the top 3 things this morning, Arthur, and that's gold does not like up dollar up rates.
Right. Yeah, I felt like I'm going through Hedgeye boot camp here with I'm thinking out of 2 sides of my head. I mean, the position or the data as it comes out, the macro data is coming out is falling right in line with what I'm thinking, what Hedgeye's thinking, what the data is saying. It's all right there.
Mm-hmm.
And so got a little surprised on the one ETF duration move today.
Mm-hmm.
Was very, very small, but that took it off. So I'm flat there. We'll see.
I mean,
obviously the signal changed that thing huge, right?
Yeah, exactly right. So listen, everybody's got to understand that like the signal like it went bullish on the yield, right? So like the signal changed, and you got to know, Keith, that like when that changes, when it goes bearish on that duration, he's gonna get out. He's gonna let that's just how he operates. Now that I told somebody I was speaking with earlier today, that doesn't mean that's how you have to operate, right? Like if you want to have a small exposure to the longer end of the curve, kind of like what Mitchell expressed earlier on this call, that's kind of a process position monitor, like a portfolio management, risk management situation, right, in terms of how things like how you want to manage your own portfolio, right? So if you got a rule though that like something breaks trend and you're out, like don't stick with your rule, right? But if
well, I mean, I was small. I've been small that because Keith's he's very, very good, but he'll admit he has a little rough time with that one over time, the last, let's say 12, 18 months. Yeah. So when he gave that signal today, I said, I'm out, I'm gone. So I had a small position.
Yeah.
Took that one off.
I mean, the rates have been, again, they've been given head fakes for the last year and a bit. And the move though, I will say, interestingly enough, I keep expecting the move to move higher, but it actually moved down today, and it closed at 108.63 or 64 basically to round it off. So that's still below its trend level. So that move is, it's right there. Trend's at 111. So be very conscientious about that. But that's something to be again to Mitchell's point, right? Like the low end of the risk range is at 3.40, which is below on the US 10-year yield. So that is below trend. So you're going to get some oscillation here, right? And but the signal definitely with that higher low and higher high that recently put in, that momentum is to the upside at the moment.
Yeah, GDX got down right to the penny on today's risk range. So when we're in a place like we are right now with a market that is extremely difficult, and I've been in this since '85, so that's a lot of years. I'm an old man, and I've never seen a market with such opposite kind of ends of the spectrum and everything in between, and trading in kind of the way that it is. Which my comment tonight would be, I'm sticking real close to Keith in the risk ranges. It's the process has to be followed right to the level that you're very careful. Because I think Chris made a comment before I came on to talk. I'm in his camp. I think you got to be really careful in here. I think that we're in that kind of time and place where I think people are complacent. Obviously, the equity space is very complacent. You see the data coming in. There's just a lot of. I haven't heard the only narrative, if that's the way you want to frame it, that I've heard that's making sense to me is the one that Taylor gave us, I don't know, a month or so ago, about Yellen giving the IOUs to the Treasury, and that's creating some liquidity to keep this thing going. That's got to be it. I mean, I can't think of anything else that makes any sense. So keep it very close to the chest in here, following the signals right to the penny. And when there's a move, take it. I mean, today when the ETF Pro update came out, boom, I'm gone. Within 5 minutes I was gone. Mm-hmm. So that's what I mean. I did short some more BITO today, mm-hmm. But that's all I did today. A little GDX, a little BITO, and I did short a little XLK.
I was going to say XLK. Yeah, XLK is kind of tough in the risk range. Yeah. So that XLK is a similar format, setup that we've seen a number of times during these quad fours over the last 14, 15 months, with Apple going bullish. Sometimes Amazon joins it, or Tesla, or something like that. Again, I know Tesla's not in XLK, but I'm just saying generally some of the big boys, right? Or Microsoft kind of goes bullish or neutral temporarily, but definitely Apple. We've seen Apple go bullish a number of times, probably at least 3 times on each of these bear market rallies, and then it returns.
Robert,
yeah, go ahead. Sorry.
With Tesla, gotta laugh. Okay, but you got Tesla in there, and you got Amazon in there. The XLY I'm talking about. And it's sitting up there. I mean, that thing, I'm almost having to sit on my freaking hands. Thinking, geez, oh man. I think it was the last couple days. It's been the top sector performer. I don't know what it was up. Ended up today 150. I don't know where it ended up. It was up a couple percent at least today again.
It was number one today again. One spot 17. 1 spot 17. It was
and we know how good shape the consumers
in. Yeah.
We know how good shape the consumers in and everything. So I mean, and Tesla's just kicking ass in China. So man, I'm big long XLY in here.
Yeah. Oh, yeah.
Anyway, that one's. I was just. It looks very, very juicy if we get some kind of a pullback here. But, this market's been going up for almost 4 months. And that's we give it time and space, but something's maybe around the corner. We'll have to see. Tomorrow's PPI will be interesting.
Yep.
That's all I got, Robert. Thanks.
No, and so on XLY, let's finish that because I like where your head's at here. So, if you look at your trend risk range from a week ago, not this past Monday, high was 157. Now it's 156, but the low end came up from 130 to 132.
So it's tight. So
you got a higher low, but a lower high. Again, just barely, but a lower high nonetheless. And really, that's the first sign. If you're kind of looking through the signals and the signal strength, the lower high here, when price continues to kind of basically has done what it's done within XLY, especially sort of, pulled back going into the close Monday. So that close Monday, that price was down at like 148.15 is where that risk range got priced, right? Mm-hmm. So if we hold up here, again, just the way that the risk ranges work, it's price volume volatility. So if we hold up here, I'm going to just round it off at 154. Don't be surprised if that top end of the risk range moves up a little bit, but if it doesn't, or if it kind of stays relatively close to 156, 157, that's a tell for you that it's having a hard time pushing higher, right? Because that high recently on a 1 month and 3 month basis was on, I think that was Tesla's earnings day on February 2nd, came in at 156.16. So, it's right now, if it keeps closing kind of below that, it's just confirming lower highs at this point in time. So again, I'm not saying, the XLY button has not been hit on RTAs, but Arthur, you're spot on in terms of what you are looking at in terms of some of the key ones here that are popping off the page, but being patient about and not fighting the tape and all that kind of lingo that you hear on Old Wall, right?
One thing
it's
to
waiting. Yeah, go ahead. Sorry.
One thing to note on XLY is, Elon's been touting on Twitter his they have some event here coming March 1st or something.
Yep.
And they're going to run this thing right into the event. So I mean,
oh yeah, and
that's kind of what
beauty,
I'm looking at.
And the beauty with XLY, exactly, and the beauty with XLY, even though you don't get like all XLY specifically on a daily basis, you do get Tesla and Amazon. So watch those two as like read-throughs, right? In terms of, again, those are like huge components, and they have broader read-throughs too, like Tesla and Amazon. Like they have read-throughs to Qs and all this other, like again, like that's they're big components out there and widely held. I showed a 13F tweet that I'll put up into the nest that I thought was pretty interesting. Again, a lot of the factor exposure from a lot of from a number of these relatively well-known and high-profile hedge funds have big growth factor exposure. Now, again, a number of them had quality balance sheets too, but growth is still very widely held. And if the quad data plays out and the market plays out the way that we potentially see it happening, there's absolutely, like, you have not seen volume, right? Like today, I said this last week, and I highlighted it this morning. Volume was down minus 8% on a 1 month basis, minus 20% yesterday on a 1 year basis, right? So these are big moves. The day before is down, volume was down 30% on a 1 year basis and down 19% on a 1 month basis, right? The day before that, on the 13th, I actually forgot to write that one down. But these moves are massive, so it's very interesting, right? So it's very interesting on low volume, and we know, like, again, it's price volume volatility. We know the metrics. One is certainly not confirming these moves higher at the moment.
Last thing I got to say.
Yeah, by all means.
You call me high yield guy, whatever, junk guy. I am, but I've covered just about everything, man. High yield and junk are right near the low end of their range. I mean, I've covered I've got minimums on those, just as an FYI. I know I was
nice.
Beating
okay.
them. I was beating them like a horse for a long time.
Yeah, for a few weeks.
That was when they were a lot higher.
But now that it moved your way, you said,
I'm just
I'll take a breather.
I got a little note in the book that I can sit there and watch it, but that's about it.
That's amazing.
I still think, obviously, I think we all believe it to some extent or another. Cost of capital is going to go up like crazy. See if these companies all went out and got what they needed, so it's going to be a while. I don't think it probably will play out till at least the second half of the year, if not even later, before we really start seeing, the shit hit the fan in the credit market. We'll have to just wait and see, but I'm just following the risk ranges on those and any signals.
Yeah, spot on.
Thanks, Robert.
You got it, man. No, thank you for all your contributions. I greatly appreciate it. Owl, the one we haven't heard wise old Owl.
Oh man,
too. How you doing, man? Thanks for joining. I'm glad you were able to make it.
Yeah. I still got a real job, so sometimes 4:30 is tough. But I did listen to the replay over the weekend, and so thanks for making them available. And Arthur, you were talking about time and space. I joined 15 minutes late, so apologies if you guys reviewed this. But looking back at the VIX over trend, so 3 months, it looks to me like if we keep bouncing around in kind of this 18 to 22 VIX range, then in some number of days, we're going to flip to neutral and then possibly flip bullish, or excuse me, bearish. And I think if we get there, that's going to change a lot about which way most of the people on this call are leaning. And I just wondered if you guys had been charting that out to see when major trends like that might be flipping.
Al, can you say that one more time? Sorry. Man.
Oh, sorry. So given that the VIX is way down since Q4, right?
Yep.
And we're looking at a 90-day time frame for trend. how much longer does it need to bounce around in kind of this 18 to 22 zone, before VIX flips bearish? Well, neutral first and then bearish.
Got it. Yeah. So trend level. The last trend I have from Keith, I think, is from earlier this month, the second. So about 13 days ago. That level was 19.11. So we just went. So again, I mean, we kind of flirted with it 2 weeks or so, or a week or so ago. No, around the second, which is why I guess he probably gave it to us. So we flirted that, and then kind of almost immediately moved higher above that, and today closed at 18.22. So the way Keith typically does it is, typically he'll kind of give it a couple of days, or 2 to 3 days to sort of breathe and either confirm or not in terms of the shift, right? So I think the bigger, or the thing when I'm looking at VIX, Al, that I am seeing or trying to kind of like anticipate is that if you go back on that, this is a great call it out in terms of on a 1 month basis. The high there is I'm going to pull it up for you, is 20.72 put in on February 9th. And that low is 17.86 put in on February 1st. So that's the band right now. So it's again, to round it up, to your point, exactly right, like 18 to 20 and 20, like 21. But that, so it would need to kind of confirm, to answer your question, the roundabout. Sorry, I'm not trying to be roundabout here, but the answer your question needs to close and maintain close below 19.11, which again, that's from kind of 2 weeks ago. So that number may have shifted, and so I'll kind of leave that up to Keith to sort of dictate that. But it has not really closed and held below that for a number of days to sort of shift that signal. The thing here, though, to me, and this is again a phenomenal question, because we've got this tight band, and you're seeing that even with the risk range. We've talked about it a couple times over the last few weeks. Whether we break out or go lower, this is the question to me, right? In terms of, okay, do we does that low end of the risk range start to move lower and signal lower lows? Currently, that is not, that's not the case. So the low end of the risk range today was 17.91, which is above that 1 month low. Mm-hmm. But the top end of the range at 21.44 would be new 1 month lows. 1 month highs, right? So that is, keeping an eye. That is a key thing that I am keenly watching is the VIX and volatility there, because I think that along with the volume and the price action, will really be able to help sort of anticipate or whether we break down into the investable bucket, or if we kind of break back up into kind of the middle of the chop bucket and higher, and potentially really vol explosion here. So that's a critical piece here. I think it's a huge call out. Great job, Al. I appreciate it.
Well, thanks. But it's been on my mind a few days, because it just seems to be kind of, like I said, bouncing around in this little band. And
yep.
I don't have Keith's machine, but it seems like, okay, tick tock, tick tock, tick tock.
Yep.
The longer it stays there, the more it's likely to flip.
Exactly. And just to kind of finish this thought here, on a 3 month basis, that high goes back to December 12th and it closed at 25.01. So again, just to round it out, you're basically 18 to 25 on the longer duration, sort of like that's again within the last 63 days or less, and that there, so that high is 25.01. So like basically again 25 to 18 is really kind of that range, or this is a critical thing to me right now. Again, you kind of had a breakout ish on Monday, but it didn't close out. It didn't close there. It closed actually below kind of the high. So it was a bit of a head fake lower, but again, if you look at kind of what Keith did on Monday, he was covering a lot of stuff on Monday morning. So I think again he did that quite well. And now 2 days later, we're down at the low end of the risk range with with the S&P kind of probing up towards the top end of the risk range.
And
But
puts are
kind of
cheap,
failing though too, right? Like, but kind of failing because it only got to 41. VIX is at 18.22, low end of that range is 17.99, or sorry, 17.91. But the VIX couldn't quite get. Normally when you see that happen, oftentimes I shouldn't say normally, there oftentimes you see really the S&P SPX really probe that top end and almost kind of move through it. But it didn't do that today. So an interesting component.
Yeah, and I'm assuming that NASDAQ and Russell look similar. Because a lot of these names that we're following really are more NASDAQ environment than SPX. But anyway, well, thank you very much, Robert. Those are really good answer. And then another thing that in this I'm glad I'm not the only old guy out here, but I will say that I've got a lot of good old friends who have had long and profitable careers in the high yield capital markets and fund management business, and they're all freaking retiring. They're 60,
wow.
but they see the light in the tunnel, and it's a train.
Wow. Well, I see George Syracuse out there. You tell him that there's few other young advisors, including John. I know he's on the West Coast, but there's if they're wanting to figure out how to get their book in good hands, Hedgeye Nations has and Keneally's out there. Yeah, we got a ton of folks out there. Mike Loftus. Anyway, yeah, ton of great advisors inside of Hedgeye Nation now. So that's amazing, though. That's very, very interesting.
And one of the things that we were talking about, and this was over cocktails last week with one of these guys. He said that the rating agencies really have two main metrics. It's their leverage ratio and it's their interest coverage ratio.
Mm-hmm.
And as rates have gone down for decades, let's just say that the rating agencies may have been a little bit more lenient with in emphasizing the interest coverage ratio, because with low rates you can lever up and still have great coverage. Problem is, if you got to refi at higher rates, it blows up that logic. And the rapidity of the increase in rates over the past 12 months, I think may have surprised so many people in so many places, that the longer we stay at these types of levels, the more there's as companies need to refi their debt. And Rob Simone does a great job of describing this on the call, by the way. They don't have to panic unless they have a maturity staring them in the face. But anyway, I'll leave that there.
Yeah, absolutely.
The other thing that I wanted to talk about with respect to rates, and this may just be gibberish, but we've talked a lot about how 10s 2s is what was it today? It got to negative 90ish, and then backed off a little bit.
It backed off. I think it closed.
No, looks like
closed at minus 83.
On my screen, it was about 91.
Sorry, yeah.
Or no, 81.
I think close. Yeah, maybe I'm catching. Yeah, you're right. You're right. Yep.
But when we were recording, the previous records for 10s to 2s, which got well over 100 basis points back in the early 80s, we were in an environment when the 10-year yield was like 14, and so it occurred to me that maybe we should think to get the proper perspective is, rather than just doing the spread, do the ratio. So since I had some time on my hands over the weekend, I pulled 10s and 2s since the late 70s, and you'll notice that the 380 divided by 461 is like 82%. I think that's an all-time low in the ratio, just because we're in a different environment. And because the durations of bonds are much longer when their coupons are low, like, you know, a lot of what we trade and what's in the market and how people borrow. You know, I'm thinking maybe this, you know, what's happening to the yield curve is going to be way more impactful than it was, you know, what is it? Shit, 40 years ago.
Yeah.
Anyway, it'll probably take somebody like Drake to.
Yeah, Richie. I know Richie's listening in. He's slacking me right now. He's sending me all. He did just send me some awesome data on the Bloomberg zero DTE, on the board. What was trading out there? But yeah, no, Richie will probably dive into that. He loves data.
Oh yeah, and you know, I was just dropping it in an Excel out of Fred.
Right.
But you know, so it's easy for me as a non-Bloombergie to be able to, you know, just do on my own, you know, home PC.
Super cool.
But that was interesting. And then, you know, the other thing you guys were talking over on last week about the zero DTEs. I mean, you know, when I first saw that, it's like, oh wow, this is, you know, all of that massive delta hedging that the street has to do in order to, transact that business and zero DTEs, you know, has to be, you know, spoofing the risk ranges. And, you know, I'll be the first to admit, I mean, I was, late in the day, I'd see, you know, take your pick of whether it was, you know, Apple or whatever. I said, oh, I'm going to short that sucker because it's right at the top end of the range, and then I get run over. So, you know, basically after a couple of days, I did as my dad always used to tell me, you know, when you're beating your head against the wall, it feels great when you stop. So I just kind of took a break, and I think that's what Hedgeye Nation was doing too. But I wonder if there are how the models absorb all that extra volume that, you know, would have to come from the delta hedging of, you know, transacting those options. And I'm assuming that just gets captured, you know, regular way, the way Keith has always been doing it. But it's a hell of a manipulation.
Yeah, it's captured. I obviously am not privy to the specific mechanics of such, Al, but he did sort of forward a note around that subject matter, and I can assure you that it's being captured.
Cool. And and it's just I think it was Mike Green who described options as just a great source of non-recourse leverage that anybody can use. And I think that's a great way to get a kernel of it. And then when you think, with the options pricing, that, Black-Scholes is a function of the price of the underlying. And when the derivative is driving the underlying, what do you really have in terms of an option pricing model?
Right, exactly. It kind of puts things on its head, right? Yeah.
Well, yeah. It's like, a guy I know who used to run some big funds, with small strategies that, once you got too big in the strategy, then you start getting in your way. And he called it making your own weather. And I think
I like that. Yeah.
And I think it's kind of that way. Anyway.
I mean, the volume. So that's a great. So Al, just again, we don't need to get too much into the zero DTE because another
I
great
think we kind of been there, done that.
Yeah, exactly. But in terms of volume, I mean, listen to this volume today. So we got the SPY 412 calls, 360,000 contracts traded. SPY 413s, 270,000. SPY 412 puts, 257. SPY 411 puts, 257,000. And then you got the SPY 414 calls at 245, and then the next two are Tesla calls at the 220 and the 215s, both traded 194 and 180,000 respectively. So I mean, that is I'm not going to do the math real fast, but I think that's somewhere between 1.5 million basically contracts trading today on all all the SPYs were zero DTE, and then Tesla expires on Friday the 17th. So that's insane volume. I mean, it's insane volume. So yeah, just to give people a glimpse as to what that. Yeah, just crazy.
Yeah. Well, anyway,
And those
thanks
puts,
for sharing that.
No, good. No, absolutely. Al. Yeah, no, great commentary, buddy. I appreciate it. Speaking of a great advisor, Blair Applegate, the one, the only. Welcome back, buddy.
Hey,
Thank you, guys.
coming at you from sunny Laguna Beach, California.
Sunny Laguna Beach. Are you going to grace us with your presence again in Hedgeye Live in May, or what?
I hope so. I hope so.
That
would be a lot of fun. I wasn't able to go to the one in LA, which I was heard was great because I had a court date for my foster son, and I'll just share that we've since had very good news, and we're in the process of hopefully adopting him this year in 2023. So I'll just leave it at that. But I definitely I'll share if you ever get a chance to do something like that in your own family. You really can make a huge impact, and you'll probably benefit more from it than the little one. That's how I feel about it. So
that's amazing.
Yeah, I can't wait to Hedgeye Live.
So happy to hear that, Blair.
Next May.
Yeah, so happy to hear that, man. That's congratulations. I'm thrilled for you.
Man.
Yeah.
Hey, so I thought I shared something. I shared a tweet that I thought everybody that's on this call would really appreciate. I know that everybody's been waiting for, the earnings recession, bear market number 3, whatever you want to call it, right? To kind of, start cooking. And obviously the market's been, pretty interesting. We're all trying to figure out the full cycle investing. We talk about that a lot, full cycle investing, getting it right. And there was an ETF conference in Miami a week or two ago, and Mike Wilson from Morgan Stanley was speaking. He was being interviewed, and he shared a couple of macro nuggets that, he went through it really quick, but I thought everyone here would really appreciate it. And it really spoke to, full cycle investing. How do you allocate your assets through that cycle, right? And, if you think there's going to be an earnings recession, a quad 4 slowdown with, growth slowing, inflation slowing, earnings recession, how do you allocate your capital? And he said the sequencing is always the same. So this is, right from Mike Wilson, how he's looking at asset allocation. And you start with cash. You own cash, or you're cash heavy, which that sounds familiar, right? Then you go to duration. And you start owning, you rotate out of a heavy cash allocation. And, in cash right now, you can get almost 5% on, very short dated Treasury notes, floating rate notes from the Treasury. You can get paid really well right now owning cash. But then you rotate from that cash to longer duration. And in fact, I remember Michael Taylor, who I respect a ton, talking about wanting to really load up on the 2-year and being able to ride that down when you get deeper into a recession. So that's an example of duration. Although 2 years is not very long, you can, you get even more duration, like long treasuries, long dated, munis, long dated corporates. And then once you ride that curve a little while and rates, start to go lower, then you move to the next step in the cycle, which is credit. That would be, high yield, junk bonds, etc. And you move to that part of the investing cycle. Then it's securitized assets, mortgage-backed securities, etc. And after you're through that part of the allocation cycle, then it's equities, right? Then you start loading up on equities. And I thought it's a really interesting way to look at the full cycle investing. I thought everybody here would enjoy that clip. I tagged the clip on Twitter. Started about minute 4.5 is when he walks through that. It's only about an 8-minute interview total. If you want to listen to his thoughts about an earnings recession, I thought everybody would appreciate that because, we're all trying to figure out how does the macro process work? What's the full cycle investing look like? Where are we in that today? And how should I be allocating my assets? So I thought you guys would enjoy that. So I'll leave it at that.
No, great, Blair. And I pinned it to the tweet nest up there. So again, if Mike Wilson goes bullish, I think Keith will throw the entire kitchen sink at on the short side. But I think I
Well,
haven't
and
watched
that's
it
the
yet.
point is
But
he's not
no,
bullish
and I'm
right
just
now, right?
teasing.
He's
But I'm just
actually,
teasing. But yeah,
and I think what's interesting is here's a guy from Morgan Stanley who's basically in charge of equity allocation, and what he's
yeah,
telling people is right now it's cash,
yeah, yeah,
and so that you got Keith, who obviously very respectable, saying basically the same thing, super heavy in cash. You got a guy like Mike Taylor, same outlook, and Mike Wilson from Morgan Stanley. So we're all just trying to figure out the macro process and how do you allocate accordingly. And so there's three different guys, three different universes, but they're all talking about something very similar. And I thought this is a good look at the sequence.
Yeah, 100%, man. So yeah, so that video is a great tweet, and thanks for sharing. It's up in the tweet nest, and my good
Sure.
buddy over at Steve. I got it. A friend of mine at Stifel. He sent me a text yesterday, or it might have been Tuesday, but no, what day we're Wednesday, so I think it was yesterday. But he sent me a text saying like ran a shock analysis just along your lines of in terms of duration, right? So, imagine that we have three more rate hikes, and then it stops. You
Right.
buy a 30-year Treasury, and they cut 200 basis points over 3 years. It's 40% plus total return plus the coupon. 17.5 duration, right? So it's these things are again, these are things to have in the back of your mind as you're reviewing the signal on the 10-year and 30-year, right? Like it's
right.
that is again like it's obviously his analysis was incorporating three more rate hikes. I think I said right. Three more rate hikes. But yeah, I mean, this is when you see that pivot, that's one way of many go towards like the TLT, but another way of playing that is actually, to your point, Blair, getting investing in the actual longer duration Treasury and expressing in that regard because you'll get the coupon, and then it's you can also get the great job, great call out as usual.
Thank
you. All right, so anybody, we're wrapping up, we're about hour and 45 in. Maybe time for, we've had some great conversations tonight, some great questions. But if anybody in the crowd's got kind of a question or two to end on, we can do that. Or Blair, if you got anything else kind of in your tool chest that or in the notebook that is jumping out at you, we can finish off with you as well. I don't know. We covered a lot of stuff tonight, so.
No, I'll leave it at that. So cash, then duration, then credit, then securitized assets, then equity. That's the full cycle investing sequence. Thought that was a good.
I love it. All right, let's just wrap up there. It seems like a good way to do it. Blair, thank you for jumpking up.
Yeah, my pleasure.
John, appreciate your time as well, and everyone else who's contributed to this evening, and all the again great speakers, great commentary. Great questions. So hopefully everybody enjoyed that. Next week, for those that are listening in that aren't part of or aren't kind of paying subscribers, what have you, we've got All Access Week. So it'll start on Tuesday, All Access Week. It'll go through the following Monday because this upcoming Monday is a holiday. But All Access Week is happening next week. So for those, even if you are a sub but just have a subscription or two of Hedgeye's products, please look for that email in your inbox or kind of it on the website and take advantage of that all access pass. We rarely do it. I think we did it once last year and kind of repeating that process this year. But yeah, a great opportunity to kind of get exposure to a number of the products that and the kind of influences in terms of how we all here on this call think and execute and that kind of stuff. So looking forward to it. But thank you for everybody who joined in. Tomorrow we got a beginner's guide, and I'm on a little holiday next week, so we will have weekly notebook review. But I think that may be the only kind of session that I'll do with Hedgeye Nation next week. So the kids are on February break. My folks are coming in from Canada, so it should be a lot of fun. But gotta stay engaged with Hedgeye Nation. I love you guys so much, and you guys teach me more than I probably teach you. So appreciate all of y'all. And with that, I will wrap up and hope everyone has a great evening.